It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group.
Managing your financial future. It's one of our favorite things to do here, and we talk about it on this podcast, which is by sheer coincidence titled Managing Your Financial Future. Johnny Dean, your podcast host, not an advisor. I'm here with the advisor, Professor Rick Plum, certified financial planner, professional. Say hello, Rick.
Hello, Rick.
Nice to have you back. I know,
type.
I threw that bone to you. It's well, whatever. But we've been doing this. I had fun last week. I really did. I mean, we got to some really good questions from people who have sent them to us via our website, which is luciacap.com. And I think I made note of this last week that I said, you know, I always give the website at the end of the show. I always say, if you want to ask us a question, please do. Send it over here, and we'll be happy to talk about it if it's a topic that's relevant to a lot of people. And we've been getting some questions over the last few months, and we've had so many other topics to talk about that I kept, I guess, forgetting to get to these listener questions. So
okay.
I've lumped them together. Last week we talked about IRA contributions. We talked about required minimum distributions. These are important things. And I think we covered tax loss harvesting, which was good. This week we have some annuity questions. And boy, is there a lot of confusion over annuities.
Well, unfortunately, people like to oversimplify things, especially people selling against them or trying to make you feel bad for buying one, that an annuity is the same for everybody. There are a lot of different types of annuities, and understanding them all can get confusing.
Well, and of course it goes both ways with regard to people who only sell annuities and think that annuities work in every single situation. Then you have the people who want to manage
bash them at all costs,
right? Because they want to manage your money, and you shouldn't have any of your money in.
Never, ever, 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 or always, 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 or those don't work in financial planning.
That doesn't work. So I wanted to cover this here because of the questions that we're getting on annuities and because of the confusion that sometimes results from products like these things. First of all, why is there, in your opinion, among some financial circles, why are there people who just say, never buy one? I threw out the fact that they can't invest your annuity.
That's probably only part of it. I think a lot of it is that they have been heavily oversold. They have been heavily misrepresented by people that sell them.
By people who say everybody should have one, in other words.
Yes. I think that they've been heavily oversold. And I think that because they sound like they're fairly straightforward and simple, in many cases they're not. But people don't look any further than what a slick marketing piece or somebody telling them, and they're being told what they want to hear.
Which is you get maybe a high rate of return.
With no risk.
Stock market-like returns.
And
no risk.
With no risk, yeah. So you want to believe it, but when you actually get down into the weeds of what this contract actually does, that's where you have to really understand what's happening. And it's what... Trust but verify, or don't even trust but verify. But just verify what you're watching, what you're seeing, what you're hearing.
And sometimes verification can even be difficult.
Well, it's complicated.
Because if you type questions online and you say, should I buy an annuity? The question is, the answer to that question is going to be likely biased one way or the other.
Well, if somebody says, should I buy an annuity? Okay, my answer would be, what do you think the annuity is going to do for you? What are you trying to accomplish?
Yeah.
Because that will tell me a lot of what they've heard and what they've been told, because annuities can be very broadly defined. I mean, the old classic definition is a stream of payments.
Well, the classic definition, as I understand it, is you hand an insurance company a lump sum of money,
and they promise a stream of payments to you for a period of time.
They
could
said,
be your life.
We will pay you this sum back
monthly, annually, semi-annually, quarterly,
and we'll do it for 10 years
or your lifetime,
or over your lifetime. And if for some reason this money runs out when we're paying it back to you. We'll just dig into our pocket and continue to pay you.
Right. There's a contract that says you give me X amount of dollars, and I promise to give you an income for a certain period. Term certain, meaning 10 years, 20 years, 30 years, or lifetime. And you don't even care about a rate of return at that point because your cash value is gone. There is no cash. All you have at that point is a promise of a monthly payment if that's what you bought.
Yeah.
And that's the classic definition of an annuity. That's why a lot of people call their pensions annuities. They're getting a monthly payment. It's an annuity.
Yeah.
An annuity is a monthly or ongoing payment for every year.
And in some cases, that annuity can stop when you do.
Right.
You can die when you do.
Or it can continue.
For a little while.
For you and your spouse. There's a lot of ways.
Sure, a whole bunch
so
of different...
even those annuities can get complicated when you look into the different payout options. But that was the classic original annuity. But insurance contracts that are not life insurance or annuities, they can be deferred. They can say, put the money in today. I'm not going to pay you anything for a payment, but I'll let you defer all the earnings on however it's invested until some time in the future. And so now we've got a whole different class of annuities. We've got the stream of payments, the classic, what they call immediate annuities, and you've got deferred annuities.
A deferred annuity means what? That you hand the insurance company, and they're all go through.
Well, it depends.
Company.
You give the insurance company. Some of them are single premium, single payment, where you put money in one time and then just let it run and let it grow. Hopefully, grow.
So you don't get immediate payments. In other words,
there's no immediate payment from a deferred annuity.
So you hand them the money and you're getting nothing back for a certain period of time.
You're not getting back any payments, but you could be accruing value.
Oh, sure.
Yeah. We'll get into that. How you accrue the value then differentiates into different types of deferred annuities. But this is another confusing issue, that every annuity has a annuitization date, a final date where it will turn into a payout. Now, they usually set it at age 95 or 99 or 100. So a lot of times, if you have ever bought an annuity, there's going to be a final maturity or an annuitization date. And if you look at that date, that's a long way out there in most cases.
Yeah.
But every once in a while, we find somebody who's 96, 97, and they're coming up on that final annuitization where at some point, you got to take money out of this thing.
So, I imagine those payments would be pretty substantial.
I mean, some of them are lump sums.
Or lump sum. So,
but anyway, so every deferred annuity at some point is going to turn into a payout.
Yes.
But it's what happens in the meantime. Now, annuities, while you're waiting for it to pay out, while it's in that deferral stage, it's a tax-deferred investment.
In other words,
what happens in the annuity stays in the annuity.
So if the annuity somehow...
if it earns interest, you don't pay tax on that interest until you take money out of the annuity.
So there
if it earns, if you've got it in a variable annuity that's in a sub account, with mutual funds or type things with stocks, and it appreciates, you don't pay any tax on that appreciation until you take money out.
Now, there may be fees in certain instances.
That's another big issue.
And that's another big issue. So you talked about interest, if an annuity earns a certain amount during this deferral period.
Uh-huh.
The question here was, can an annuity provide, they said, a 7% rate of return / income? Now, that's two different things.
Right. Rate of return and income don't necessarily equate to the same thing.
All right, so talk about what they're talking about here, because have you seen these numbers? And I don't know if I've seen 7% lately, but have you seen some of these numbers where they throw them out and say this annuity product, and they throw out a giant number like 5%, 6%, 7%?
Yeah, these are the more recent type. They've been around for 20 plus years now, but they're the more recent type of annuities, which are income. They have an income base to them. They are lifetime income annuities. They're not annuitized. They're not where you trade in the cash value. You have no cash value. All you have is a promise for a stream of payments. These are ones that promise you a stream of payments that is equal to a specific number for the rest of your life. At first, it's going to be coming from your cash value. So if I put in $100,000 and I start immediately, maybe they're giving me $5,000 a year. And if I run out of my $100,000, they'll continue to pay me $5,000 a year forever.
And
but let's say I change my mind after 1 year, not including surrender charges or anything like that. There's $95,000 left. my 95, I could take the 95 subject to surrender charges anytime I wanted. So whatever the cash value is still there.
Minus
other
surrender
than what
charges.
Other than what I'm taking out on an annual basis for what they've promised me. The promise actually doesn't come into play until I've exhausted the cash value.
So if I put $100,000 into one of these, how do I know how much it's going to? Do I want it to grow? Does it matter?
Yeah, of course
to me?
you want it to grow. I mean, anytime it grows, you're going to get more in the future, and so that's one of the whole purposes. I mean, we want it to. Now, the real thing is, this is where the devil's in the details. What is it that I'm actually getting? When you hear about these annuities that are paying, supposedly, I'll say, paying 7%, it's not a real number. In today's environment, 7% is not a guaranteed rate of return.
In other words, if I put $100,000 in, it's not going to be worth. I can't take out $107,000
next year
after a year. It's not. It's not. I'm not earning.
Nope, not at all.
7%.
Now, in the 90s, we could do that. You could buy a fixed annuity and get a 7% rate of return over an 8-9 year period of time. But then CDs were close to that too back then.
Right, but you're not going to get that.
You're not going to. What happens is there's a component to it. So there are these lifetime income annuities that say we will guarantee a specific amount of income for the rest of your life. That income is going to be based on an accounting number inside your contract called the income base or something to that effect. That income base, which is not a cash value, which is not something you can surrender and take the money out of, that income base can be guaranteed to grow at 7%. The income base may be guaranteed to grow at 10%. I've seen that. The income base is so let's say I put in $100,000. I have an income base that's going to grow at 10% a year during the years before I start taking distributions.
So while I'm waiting and doing nothing,
my income base next year will be 110. The next year will be 120, 130, and down the line. My cash value is not growing at 10%. My cash value may be growing at 2 or 3%. Or it may how the cash value is actually invested differentiates between what type of an annuity it is.
So the income base is just a number.
It's a number that's
not a value of an account.
At some point in the future, so let's say 5 years down the line, I've had that 10% roll up, and now my income base is $150,000, and my cash value is $115,000.
Just making up the
Just
numbers.
making them up. There's a percent that I can take out of that income base or calculate. So I may be able to get 5% of that income, maybe 65 years old, and they'll say at 65 you can get 5% of the income base for the rest of your life. So 5% of 150 is $7,500. So I now start taking $7,500 a year out of this contract. That $7,500 is starting to come from my cash value. So that $115,000, and maybe it earns 1 or 2% each year, a couple percent each year, but I'm slowly, at first, whittling away that cash value. And at some point, if I live long enough, that cash value is going to go away. And that's where the insurance company steps up and says, I promised you $7,500 for your life. I'll continue paying you $7,500 for the rest of your life. As long as you live, you're going to be getting $7,500 a month because that's what the contract,
a month or a year,
the contract said. That's where the guarantee really comes into play. Now, what happens though is they're not free. The insurance company is on the hook. If this cash value goes to zero, they're going to have to pay out some money. So they charge you a fee for that guarantee. There's no free lunch.
Where does the fee come from?
Fee comes out of your cash value.
Out of your cash value.
And the fee may be, 60 basis points, 0.6%, maybe 1%. For ease of math, let's call it 1%. It's not 1% of the cash value. It's 1% of the income base.
Ha, ha, ha. So if I have $100,000, if I have an annuity which has an income base of $110,000 after a year, and my cash value is only $100.
Well, let's go back to my 5-year one, $150,000.
Okay, after 5 years.
After 5 years, and now my cash value is now. Let's go 5 years further. My income base is still 150, but my cash value may be down to 85
because you've been taking
I've been
money
taking
out.
money out.
Yeah.
10 years later, it may be down to 50,000. Well, I'm still paying that 1%. Not every contract is this way, but most of them are, where I'm still paying 1% of $150,000, $1,500, and it's coming right out of my cash value. At some point, that becomes a much larger percent of my cash.
If I'm paying $1,500 of a fee, and my cash value is down to $100,000.
The cash value may go to zero, but the insurance company will continue to pay me that $7,500 a year for the rest of my life because that's what's contractually guaranteed.
Do I have this fee for the rest of the annuity? What do I do when it comes down, when the cash value is at zero?
The insurance company doesn't charge you it anymore.
They don't charge you a fee
now the
anymore?
guarantee is kicked in. Cash value is gone. Fee's gone, but now the insurance company's paying. But you're also probably 95 years old.
But okay, so
or maybe 75, 85.
But if my cash value is down to $10,000 and they're charging me $1,500 because that's how much,
and I'm taking $7,500 a year out.
But I mean, I'm at a 15% fee of my cash value pretty much at that point.
Still 1% of the income base. See, these are the important things you have to understand. Now, that doesn't mean that these are bad contracts. For somebody who wants, needs, or desires guaranteed income that they cannot outlive, because maybe their Social Security is X, but their bills are X plus. And so they want to make sure that under no circumstance will they never not have enough money to make their bills. You're not buying it for the incredible rate of return. You're buying it to have that guaranteed income for the rest of your life that you can never outlive. So, obviously stay with a good insurance company. But it's not that they're bad. They're just not for everybody. And we've only scratched the surface on the complexity of these, because how is that cash value invested? Is the cash value invested in a guaranteed account that pays interest? Is it invested in a guaranteed account that pays interest based on the movement of an index? Is that cash value invested in variable accounts, sub-accounts that look like mutual funds and act like stock or bond mutual funds? How is that underlying investment managed? And that also dictates what the fees are from the annuity side of it, not just the rider of the lifetime income.
Well, my question was going to be, if you're just buying this for the guarantee of payments, why would you care what your cash value is earning? Is it because if you don't make it all the way?
I'd like to have something left over for the kids if possible.
So if you don't make it to the end of the into the guarantees,
my roll up, my increase in my income base, let's say it's a 5% roll up every year. But if I have it in an account that could grow at higher than 5%, even after the fees, I could get what they call a step up. So maybe I use a variable contract and I put it in a year like 2021 or 2020.
2021.
Pick a good year,
let's say 2021.
Where the stock market just went on fire. And my cash value went from 100,000, even after fees, it went up to 115, 118. Well, that's higher than my income base would be. They can reset the income base to a higher number. So now I have the ability to get a higher income for the rest of my life.
Oh, well, that's not a bad thing. So that's one of the reasons why you should care somewhat about how it's invested.
But that also depends on, it goes to how you design the product for the individual. One of the first things, if somebody's talking about a lifetime income product, when are you going to start taking income from it? Right away? Or are you going to wait 5 or 10 years? I know some people that bought these at 50 and they're not planning on taking it until 65.
Well, they must give you some kind of decent reward for waiting so
long. Well, the
long.
income base grows quite a bit.
Yeah.
I mean, it can, depending upon the contract. But these are the inner working minutia, devil in detail things. What is my income guaranteed to be? What are my fees going to be? What is the investment going to be? How do they work together or against each other to benefit me, if at all possible?
Now, what would happen if you, and this leads into the next question from a listener here. You put in $100,000, and let's say you only live, 10 years, and there's still 50,000. I don't even know how much. Let's say there's $50,000 left of this 100,000 that you put in of cash value. The insurance company has guaranteed that you will get these payments for the rest of your life. Your life is over. Your life is over. But there's 50,000, let's say, left as cash value. This can be inherited by somebody.
Right. There's a beneficiary on the contract that will receive that value. So they're going to receive either the cash value or, in some contracts, one of the more popular contracts, they have a death benefit. So I put in 100. As long as there's at least $1 in the cash value when I die, my heirs get 100.
There are contracts that are like that.
Right.
I would imagine there's a hefty fee for that guarantee.
Hefty is relation, relative, excuse me. Hefty, it depends. I mean, for some people, it's not like it's 15 or 20% a day. But there is a fee for it, but you have to evaluate whether that makes any sense. And also the payout may be slightly less because The insurance, it's just one of those things you get
All
what
right.
you pay for. But so the death benefit could be the full amount. And so some people may say, look, that makes sense. I want to get this income. And if I live to be 100, fine. I don't need the death benefit anymore because in many cases, my heirs may not be alive anymore. Who knows?
Well, that's true.
But if I only make it to 75 or 80, I'd like my heirs to get what I put into it.
So if you here, the next question was, what are the tax ramifications of inheriting an annuity? So let's say that I inherit an annuity. Somebody had $50,000 of cash value. They died. They're not getting payments anymore, and there's this $50,000 of cash value in this annuity. What happens? How is this treated by somebody who inherits it, who may not be anywhere near proper annuity age, let's just say?
Well, they're getting a lump sum in most cases, but the idea is, what is the taxability? Well, we're obviously going to be talking about non-IRA owned annuities.
Yes.
Obviously, if the annuity is purchased inside of an IRA, the IRA rules control it as far as taxability.
And normal IRA inherit beneficiary rules.
Right. It's all about, it's an IRA.
Yeah.
The investment isn't isn't the deciding factor. It's the IRA that's the deciding factor on the taxation. But if it's a personal, what they call non-qualified annuity, starting with that one where we put $100,000 in, and let's say we let it grow, and then I started receiving my $7,500. I have a basis. My tax basis is what I put into it, what I've already paid taxes on, what I put into it. And then as I start withdrawing money, I'm withdrawing it from that cash value. If my cash value is always higher than the $100,000 that I put into it, my tax basis, the distribution I'm taking is 100% taxable. But once I get down to a point where I'm taking distributions and I'm dipping into that 100, I'm starting to take my own money back because I put it in with an after-tax contribution. That portion that represents a return of my own money is not taxable.
So, in other words, the first money that you start taking out of this annuity is earnings, and it's 100% taxable.
Until I use all the earnings. Yeah. And then on an annual basis, they calculate, were there any earnings? If so, that comes. Were there any earnings? Did you take any money out? Were there any earnings? Yes. Did you take money out? Yes. Did you take out more than the earnings? No. Okay, then 100% taxes. Did I take out,
some of
a larger? Yeah. If I take out more than the earnings, then some of that's going to be a return of my own money, which then reduces the basis left in the contract because I'm receiving some of my money back. Yeah. So by the time I pass away and there's only $50,000 left in the contract, what is my basis left in that contract? If my basis is $50,000, my heirs can receive that $50,000 tax-free. Now, on that annuity that had a death benefit of $100,000, the cash value is 50, the basis is 50, the death benefit is 100. My heirs receive 100, and they're saying, well, it's a death benefit. I've heard that life insurance death benefits are tax-free. I should get the whole thing tax-free, right? Well, if it had been a life insurance policy, that's a true statement, but it's not a life insurance policy. It's an annuity contract, even if it is issued by a life insurance company. It still has the annuity rules. Even though the death benefit kicked in and gave you that extra $50,000 in this example, that's gain to the annuity beneficiary, and that'll be taxable to the annuity beneficiary. Anything received over and above what the basis in the contract is a taxable event.
So if they sent them the lump sum of $100,000, I'm trying to keep this simple.
$50,000 of it would have been taxable.
$50,000 is taxable at ordinary income rates.
Ordinary income. No matter just like an IRA, no matter how the money is created, how the gain or appreciation is created inside the annuity, whether it came from appreciation, dividends, interest, a death benefit paying off, money that comes out of an annuity that's a taxable event is ordinary income. There is no capital gain available. There is there's no step up in basis. There's no resetting of basis. Taxable is taxable, and even death doesn't get us out of the tax bill on this one.
It doesn't for
IRAs.
It
may get me out of it, but it'll get my beneficiaries.
For IRAs, I mean, there are certain things that somebody's going to pay the taxes somewhere,
right.
Whether it's the owner or the spouse eventually or a beneficiary down the line.
At whatever tax bracket they're in when they take it out.
Yeah. All right, so those are the tax. That's what happens,
and that's the confusing part. When you have the old style immediate annuity, I give the insurance company $100,000, and they pay me On an immediate annuity where I have no cash value left, they just promise to pay me.
Your $100,000 is gone.
And they promise to pay me $7,000 a year for the rest of my life.
Yeah.
Okay. That $7,000 that I'm receiving from it, what they call an annuitized contract, is only partially taxable. They're going to look at what would be the return over my normal life expectancy. So maybe my normal life expectancy is 20 years. So over that 20 years, I'm going to get $140,000 back. So that means that I put in 100 and I'm getting 140,000 back. That means of that $7,000, there's a proration. So I would get $5,000 of my own money back and $2,000 of gain every year. It's the same taxation year after year after year until my basis has been completely recouped, and then it's 100% taxable. With a lifetime income contract, it's a different taxation because it's not annuitized. It's what they call a systematic withdrawal. And we've had people question this, saying, why is my entire distribution taxable when I'm getting a lifetime income? Because it looks kind of like an annuitized contract.
But it's not.
It's a systematic withdrawal. It's all earnings to the extent there are earnings in the contract first. And I only get to my basis when there's no taxable event left in the contract.
So if you do an immediate type where you've given the money, the $100,000 away, it's gone. They're going to calculate it based on what your payments are going to be for
your life expectancy. And it's not necessarily your health life expectancy; it's your age life expectancy.
Well, that's the same life expectancy that everybody at your age has, right?
Well, by their tables, it's not necessarily the IRS tables.
Well, by their table, yes. There's a table somewhere.
The actuary tables. Everybody. So there's some different things, and we've had people saying, "Well, this doesn't make any sense. Why?" I had an immediate annuity that I got from previously, and it had the same taxation every year, and this one varies wildly from every year. Well, it depends on whether it's a good year or a bad year.
Are you a good year or a bad year? Exactly. So, okay, one other question here, and I don't know if we have time to answer this completely. We've kind of addressed this a little bit, but they want to know what the difference is between a variable annuity and some type of indexed annuity. Can we keep this?
Sure. It has to do with how the cash value is invested. With a variable annuity, the cash value is invested in sub-accounts that look like mutual funds. So they're stock and bond investments. With a variable annuity, when you're invested in these sub-accounts, there's no guarantee of principal. Just like if you used a mutual fund, there's no guarantee of principal in a mutual fund. So
in other words, they could lose value. They could lose.
You could lose value, but you also have, you could be in a S&P index clone or something of that nature, and get all of the rate of return that S&P has minus the fee of the annuity, and it could be very high return or very low return, very negative return in some years. So variable annuities have the ability to have more stock market like returns. And an index annuity is a fixed annuity. It's first and foremost a fixed annuity. With a fixed annuity, your principal is guaranteed. You are not investing in the sub-accounts. You are not investing in the stock market. You are not investing in anything other than the general account, the guaranteed account at the insurance company. And the insurance company says, we will pay you an interest rate equal to, through some formula, the performance of an index. There are multiple indexes.
Like the S&P?
You could choose the S&P, the Russell, the EFA. There are blended index, balanced indexes, risk-controlled indexes. There's lots of indexes. And so you need to know which one you're using. But let's just use the S&P for example. Yeah. When I said they put it through a formula. So this is where the old marketing saying, market-like returns with no risk. It is in a fixed index annuity. It is a fixed annuity with no risk to the principal. As long as you leave the money in, you're not going to hit a surrender charge or any of that. Mm-hmm. And for most of them, there's no fees. Nothing. Your return will be based on an index.
Well, what happens if the index goes down?
I don't earn any money that year. But I'm not in the index. Remember, I'm not investing in the index.
So they're not crediting your account with any money in that case.
I only get credited when there's a positive return. If there's a negative return over the measuring period may be 1 year, 2 year. So most of them are 1 year measuring periods, what they call point to point. Some are monthly averaging, and so these are where the devil's in the detail. How does your strategy
Sure, okay.
How is it working? There's monthly averaging, but there's always going to be a formula for determining what the interest is. But there's also going to be something that limits the return. The easiest ones to understand are what they call point to point with a cap. So point A, contract year, point B, end of year one. And then end of year one becomes beginning point for the second year and third
So
year.
they are crediting your cash value based on this index, is
based
what
on
you're saying.
So if the index goes up 5%, I can earn a return of 5%, assuming my cap is at least 5%.
Sure. So so if you put 100,000 in and your
And
now
let's
your
say my
cash
cap
value
and let's say my cap is 5%.
and it earns 5.
If the index over that measuring period goes up 5%, I earn 5%. If the index goes up 2%, I only earn 2% because the index moved 2% during that period of time.
So your cash value is 102 in this example.
If the index moves 10% over that same period, I am capped at the 5% because my cap was 5.
Yeah.
So I'm only going to earn 5%.
What if the index loses 5%?
I earn nothing.
You don't go down.
I don't lose any principal. My principal is guaranteed.
There you go.
And the nice thing is, let's say I did go up 6, 7, 8, 9%, and I got my 5% cap. So I got 5% interest. My contract is now 105. Now that's the guaranteed part for the next year. I can't lose that 5,000 that I earned last year because it's part of my principal now and going forward. So there's going to be something, though, that limits my return of the index. A cap is very common. Or a participation rate. They may say you can participate in 60% of the upside of the market with no cap. Okay, well, then that means if the market's up 10, I get 60% of that movement, I get 6%. If the market's up 2, I get 1.2%. Or there may be what they call a spread rate. It's, a 3% spread rate. It's whatever the index did less the spread. So if it went up 10 and I had a spread of 3, I get 7. If I went up 3 and I had a spread of 3, I get 0.
Is anyone particularly better than the other, or
it depends on what they are? I mean, if I've got a spread of 14, I'm not real happy about that. If I've got a participation rate of 20, if the market goes up 20%, I get 4. I'm not real happy about that.
Well, if there are no fees on these, as you said,
there's no fees. But
then, I mean, why wouldn't you pick the one with the best?
Well, and you generally at the end of each crediting period, you can move from one strategy within that annuity to another strategy. I could go from a point-to-point or monthly average. It all depends on what you're trying to accomplish and what's going on, and it depends on what the caps are. Now, so what is the cap? What is the spread? What is the participation rate? Are they using one? Are they using 2 of those? Are they using all 3 of those? How is your strategy working for you?
Well, and doesn't this come down to what are you trying to do with it? What are you trying to achieve?
Yeah, most of the time with these types of contracts, you're trying to achieve a better than bond market return, not a better than, or you're not trying to get a stock market return out of these. And also they're typically 5+ year holding periods to avoid surrender charges. Because if I put the money in this year and I tried to take it out in a year, in almost every annuity, there's going to be a surrender charge in the first X number of years.
Well, like that CD we talked about last week.
Yeah, but the penalties on annuities are much larger.
Absolutely.
So you have to know what's going on when you need liquidity. Just understand the contract or have somebody in your corner that truly understands how these contracts work.
Let's leave the variable out for just a moment. Who should consider, perhaps, one of these types of indexed annuities that you talked about?
Well,
obviously, they're not for everybody.
Somebody who is a little more on the risk-averse side, somebody who doesn't want to see a negative number, somebody who wants to get potentially a better rate of return than CDs or bonds can do over the same period of time, 5, 6, 7 years. Somebody who does not need very much in the way of liquidity, does not need heavy withdrawals right away, okay, because you want to let it go for 5. You want to get it past the surrender charge. Now, some of them do allow 10% a year to come out without a penalty, but that's not a huge number. If you put in $100,000 and you only get $10,000 a year out, it's not going to help you that much.
Well,
so you got to look at how much liquidity I need, and if you've got 30 years for this money, you probably are not going to be looking at this kind of contract unless you're very, very conservative. And we've met those people that say, "Look, I just don't want to take a risk."
Do these provide? I mean, you had said they provide some kind of income for you.
Well,
are they more of a CD? Not a CD.
They're a bond alternative.
A bond alternative.
Now, and that lifetime income we talked about before, you can put that rider on any of these annuities.
In which case, there's a fee involved?
Once you start adding riders, there's generally fees.
Okay. You need to look at the contract.
And the reality is, if you find one that has a lifetime income rider where there is no fee, the cap rates or the spread rate, they're going to limit your return more.
Well, sure, they're going to make it. They're going to make it.
They're not giving you something for free.
No, they'll just limit your return, and they'll take that as their thank you very much. It's not a fee; they're going to get paid.
You just don't see it.
It's not.
But it's not that they're bad. It's just that they're for the right purpose. Somebody who wants a guarantee of principal, who wants to get a better rate of return potentially than CDs or bonds of similar, even 10-year bonds. What's the 10-year Treasury at? 3-ish?
Right at this recording, it's just below 3, I believe.
Yeah. And so if you've got a cap of 5, which I saw one the other day, I think I saw a cap of 5 on a very plain, ordinary vanilla S&P point to point. 1 year I might get 5, next year I might get 0. But if the market's up 4 out of 5 years, 3 out of 5 years, I expect to get 5 3 or 4 times out of 5 years. So I'm up 15%, maybe 16% over that 5-year period of time. That's better than a CD.
Well, it certainly is.
Better than a bond in today's world, a 5-year bond.
Well, that's for sure.
And at the end of the surrender period, I can take all my money and do whatever I want with it. Guaranteed.
And what are the taxes of taking your money?
Now you're back to annuities.
Once again.
The earnings are going to be taxable when they come out.
So you have to understand how the taxes work. You have to understand how the fees work. It's important to understand what it's going to cost you.
And we see these purchased inside of IRAs quite a bit, so you don't worry about the taxes because it's in an IRA.
Well, eventually somebody's going to have to.
Well, that's your IRA dictating the taxes, not the investment dictating the taxes.
And once you hit required minimum distribution age,
now you got to worry about liquidity. But obviously, if I can get 10% out and my RMD is 4%, I'm good there.
Yeah, that's true.
At least until I'm quite a bit older.
Annuities are complicated products.
They can be.
You could start with the easy ones, as we did at the beginning of this particular episode. And
we didn't even talk about the easiest of them, which are just straight fixed, what they call multi-year guarantee annuities. And those are very much like CD alternatives. But there's obviously no FDIC insurance. They're guaranteed by the insurance company, not the federal government. But you can get, they typically come in 3+ year time frames. And right now they probably could get close to 3% guaranteed for 3 years, where a CD probably is 2/3 that or less.
Right. Okay. Interesting stuff. We're out of time.
There's no fees on those.
If you want to know more about this, you want to know whether an annuity may be right for you, check with the folks at Lucia Capital Group. Give them a call, 800-644-1150, 800-644-1150. Professor Plum or any of the Lucia Capital Group advisors will be happy to talk to you about this. Are they right for you? Maybe. Are they not? Maybe. Don't ever dismiss anything out of hand, and don't ever accept anything as always being the right investment, right?
Or never being the right investment.
Exactly. 800-644-1150. Or you can go online, luciacap.com, luciacap.com. You can see our blog posts. You can see all of our videos. We have other stuff on annuities. Check it out. We'd love to have you there. Also, Spotify. You can subscribe to our show, download, listen, and listen regularly. We're getting new listeners all the time. And if you want to email us, go to that luciacap.com. Ask the questions. We'll try to answer them here on the podcast. We thank you so much for listening. It's been Managing Your Financial Future for Professor Rick Plum, certified financial planner, professional. I'm your podcast host, Johnny Dean. Thanks again. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Fixed indexed annuities are complex, long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Investors should speak with a financial professional about the contract's features, benefits, risks, and fees, and whether the contract is appropriate for the investor based upon his or her financial situation and objectives. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Variable annuities are long-term investment products designed for retirement purposes. Variable annuities with guarantees are available through optional riders at additional cost. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a variable annuity's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Before investing, carefully consider a variable annuity's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Variable annuities with guarantees are available through optional riders at additional cost. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. Russell 2000 Index is a small cap index consisting of the smallest 2,000 companies in the Russell 3000 Index, representing approximately 8% of the Russell 3000 total market capitalization. An investment may not be made directly in an index. MSCI EAFE Index is a stock market index that is designed to measure the equity market performance of developed markets outside of the U.S. and Canada. It is maintained by MSCI Barra, a provider of investment decision support tools. The EAFE acronym stands for Europe, Australasia, and Far East. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.